In the dynamic world of futures trading, two foundational concepts, margin and leverage, determine the cost and risk associated with every futures contract traded. Let's explore these two terms and what they mean for futures traders. Margin is the amount of money or capital required to enter a position in a futures market. Think of it as a good faith deposit to cover losses if the position goes against a trader. This provides a level of security for the trader, the broker, and the futures exchange. Unlike traditional margin in stock trading, futures margin doesn't require borrowing money and paying interest. With futures, margin is covered using funds already in the trader's account. The margin account required to enter a futures trade is based on the potential trading risk and is unique for each futures market. There are two types of margin in futures trading. Initial margin. This is the amount of money that will be used as a deposit from your trading account to open a position. Maintenance margin. This is the minimum amount of money required in your trading account to hold an open position. These margin amounts are based on holding a futures position overnight and are set by the futures exchange where the contract is traded. Many futures traders choose to close positions before the end of the trading day to avoid elevated overnight maintenance margin levels. As an example, NinjaTrader offers day trading margins as low as $50 for some of the most popular futures contracts. Normally, margin is just a fraction of the value of the futures contract, allowing you to control a much larger position with fewer dollars. The ratio between the contract value and margin determines the amount of trading leverage. In future trading, the term leverage refers to the ability to control the larger value of a futures contract with a significantly lower dollar amount represented by the required margin. To calculate leverage, simply divide the notional value of the futures contract by the required margin. Notional value is the total dollar value represented in the futures contract. Here's an example of leverage and notional value using crude oil futures. Let's say crude oil is currently trading at $70 a barrel. The notional value for one crude oil contract would be $70,000. 70 times the 1,000 barrels the contract represents. If the standard initial margin is $7,000, the leverage ratio amount would be 10 to 1, 70,000 divided by 7,000. And if you're day trading crude oil with a lower margin of $1,000, the leverage ratio amount increases 70 to 1. This increased leverage available to the futures market can magnify the potential for larger gains. However, this also increases the risk for elevated losses as well. Trading leveraged futures requires consistent proactive risk management, which includes a protective stop loss or trailing stop orders. In practice, margin and leverage help traders better determine the appropriate amount of capital to allocate to any one trade. Understanding the relationship and difference between leverage and margin is crucial for developing an effective risk management strategy for your trading. Start your futures trading journey with NinjaTrader. We look forward to guiding you every step along the way.